Imagine waking up tomorrow morning and discovering that everything you thought you knew about money was completely wrong. The savings account you trusted, the retirement plan you've been paying into for years, the financial advice that seemed so solid just became worthless overnight. Sounds like a nightmare, doesn't it? But here's the thing that nobody wants to tell you. This isn't some distant possibility or theoretical scenario. The 2026 financial crash isn't just coming. It's already here, building momentum beneath the surface like a financial tsunami that is about to reshape everything we know about wealth and money. While most people are sleeping through the warning signs, a small group of informed investors is quietly positioning themselves to capture the greatest wealth transfer opportunity in human history. They understand something that escapes 99% of the population. Market crashes don't destroy wealth. They simply move it from the unprepared hands to the prepared ones, from those who panic to those who have a plan. And if you understand what I'm about to share with you today, you could position yourself on the winning side of this massive transfer. The reality is that every great fortune in modern history was built during times of economic chaos. When everyone else was running for the exits, the wealthy were backing up the truck and loading up on assets at prices that would never be seen again. During the Great Depression, while breadlines formed and banks failed, John D. Rockefeller famously said that fortunes are made when blood is running in the streets. He wasn't being cruel. He was stating a mathematical truth about how wealth creation actually works. After the crash of 1929, those brave enough to buy during the depths of despair saw returns that would make today's tech billionaires envious. When the dot-com bubble burst in 2000, patient investors who accumulated quality assets during the carnage watched their portfolios multiply by 10, 20, even 50 times over the following decades. Dozens of other companies that would later define the modern economy were available at garage sale prices. And when the housing market imploded in 2008, creating what felt like the end of the financial world, it was actually the beginning of the greatest bull market in American history. The investors who recognized these opportunities and had the courage to act didn't just preserve their wealth, they multiplied it beyond anything they could have imagined. Now we're standing at the edge of another precipice. The warning signs are flashing red across every metric that matters. And if history is any guide, what's coming in 2026 won't just be another correction. It will be a complete reset of the financial system as we know it. The economic cycle in America has followed a predictable rhythm for over a century. Every 18 to 20 years, the system reaches a breaking point where debt, speculation, and artificial prosperity collide with mathematical reality. We saw it in 1929 during the Great Depression. We witnessed it during the stagflation crisis of the 1970s. We watched it unfold in 2000 with the tech bubble burst. We experienced it again in 2008 with the housing crisis. And now as we approach 2026, every indicator suggests we're approaching the next inevitable reset. The Shiller price-to-earnings ratio, which measures how expensive stocks are relative to their actual earnings, is sitting at its second highest level in recorded history. The only time it was higher was right before the dot-com crash that wiped out trillions in paper wealth. Consumer debt has reached levels that would have been unthinkable just a generation ago. The average American household now carries more debt relative to their income than at any point since detailed records began. Corporate balance sheets are loaded with cheap debt that will become crushing when interest rates rise. Companies have borrowed unprecedented amounts to fund stock buybacks, acquisitions, and expansion plans based on the assumption that money will always be cheap. But that assumption is about to be tested in ways that most executives have never experienced. Government spending has reached a point where even the Federal Reserve is starting to question whether the system can continue much longer. The national debt has exploded to levels that consume an increasingly large portion of the federal budget just to service the interest payments. When interest rates rise, which they inevitably must to combat inflation, the mathematics become impossible. But here's where it gets interesting. The same economists and financial experts who failed to predict every major crash in the past century are telling you not to worry. They're saying the economy is strong, unemployment is relatively low, and there's no reason to panic. They said the exact same thing in 1999. They said it in 2007. And they were catastrophically wrong both times. Meanwhile, the smart money is quietly positioning itself for what's coming. Warren Buffett's Berkshire Hathaway is sitting on over $300 billion in cash, the highest amount in the company's history. Major hedge funds are building defensive positions and accumulating precious metals. Institutional investors are quietly rotating out of overvalued growth stocks and into assets that hold value during economic chaos. The unemployment rate is expected to climb from its current level to nearly 5% by September 2026. Economists are placing the odds of a recession at almost 40%. But those same economists have never successfully predicted the timing or severity of any major downturn. The real probability, based on historical patterns and current conditions, is much higher. Manufacturing has already started to contract in key sectors. Consumer confidence is beginning to crack under the weight of inflation and rising costs. Credit card defaults are rising as families struggle to maintain their standard of living. Commercial real estate is showing signs of serious stress as office buildings sit empty and retail spaces struggle to find tenants. These aren't abstract economic indicators. They're early warning signals of the financial earthquake that's building beneath the surface. But here's what separates the wealthy from everyone else. While most people see crisis, the rich see opportunity. They understand that crashes are not random acts of economic destruction. They're systematic transfers of assets from weak hands to strong hands, from those who borrowed too much to those who saved, from those who chased speculation to those who accumulated real value. Consider what happened during the 2008 financial crisis. While millions of Americans lost their homes, their jobs, and their life savings, a small group of investors made fortunes that would last for generations. They bought real estate at 30 cents on the dollar in prime locations that everyone else was desperate to sell. They accumulated stocks of world-class companies at prices not seen in decades. They purchased entire businesses for fractions of their intrinsic value. The key insight that drove their success was understanding that quality assets don't lose their fundamental value during crashes. They simply become available at prices that reflect fear rather than rational analysis. The same pattern played out during the Great Depression. While businesses failed and unemployment soared, those with capital and vision acquired assets that would generate wealth for generations. Oil companies, railroads, and manufacturing businesses changed hands at prices that would never be seen again. The wealthy understood that temporary disruption creates permanent opportunity for those prepared to act. Crashes don't happen randomly. They follow predictable patterns driven by human psychology and mathematical inevitability. Periods of easy money and speculation always end the same way. Debt levels that seem sustainable during good times become crushing when conditions change. Asset prices that appear justified by new paradigms eventually return to historical norms with devastating speed. And that's exactly what's building now. We're living through the greatest debt expansion in human history. Corporate debt has reached levels that make the 2008 crisis look conservative by comparison. Government deficits are spiraling toward a point where even the world's reserve currency may not be able to handle the load. Consumer spending is being supported by credit cards and loans that assume tomorrow will always be better than today. Meanwhile, asset prices have been inflated by over a decade of artificially low interest rates and money printing on a scale that would have been unthinkable to previous generations. Stock prices are divorced from underlying business fundamentals. Real estate values in many markets have reached levels that make ownership impossible for entire generations. Bond prices are based on the assumption that governments will always be able to service their debts. But mathematics doesn't care about assumptions. Interest rates are rising because inflation refuses to disappear, despite repeated predictions of its demise. Debt service costs are consuming larger portions of government budgets. Corporate earnings are under pressure from higher labor costs and slowing demand. Consumer spending is beginning to crack as credit limits are reached and monthly payments become unmanageable. The stage is set for a correction that will make 2008 look like a minor inconvenience. But here's the opportunity that most people will miss completely. When the crash comes, it won't destroy real value. It will simply reveal which assets were real and which were illusions. Quality companies with strong balance sheets, consistent earnings, and essential products or services will survive and eventually thrive. They'll use the chaos to acquire competitors, expand market share, and position themselves for the recovery that always follows. Prime real estate in desirable locations will retain its utility even if prices fall temporarily. Precious metals will maintain their role as stores of value when paper promises fail. Before moving forward, if this video made you stop and think, then the conversation doesn't end here. Leave a comment below and tell me what topic you want us to go deeper into next. This channel exists to break down what most people are never told, and your questions shape what comes next. If you want to understand these shifts before they become obvious to everyone else, make sure you subscribe, like this video, and turn on notifications. Because what's coming won't be explained on the evening news, but it will be explained here. Quality companies with strong balance sheets, consistent earnings, and essential products or services will survive and eventually thrive. They'll use the chaos to acquire competitors, expand market share, and position themselves for the recovery that always follows. Prime real estate in desirable locations will retain its utility even if prices fall temporarily. Precious metals will maintain their role as stores of value when paper promises fail. The difference between those who profit and those who suffer won't be luck or timing. It will be preparation. Those who understand what's coming can position themselves to benefit from the chaos that destroys unprepared investors. The first step in positioning yourself for the crash is understanding that your current financial strategy is probably wrong. Most people are trained to think like consumers, not investors. They buy when prices are high and everyone is optimistic. They sell when fear takes hold and assets are cheap. This backward approach guarantees they'll be on the losing side of every major transfer of wealth. Successful crash investing requires a complete reversal of normal human instincts. When your neighbors are celebrating their portfolio gains and talking about early retirement, that's when you should be building cash reserves and preparing for the inevitable downturn. When panic grips the markets and financial media is predicting the end of capitalism, that's when generational fortunes are made. The wealthy understand this principle because they've seen it play out repeatedly. They know that fear creates the best buying opportunities in history. They know that when everyone else is desperate to sell, assets can be acquired at prices that seem impossible during normal times. They know that patience and preparation beat emotion and speculation every single time. Cash becomes king during financial crises, but not for the reasons most people think. It's not about safety or preservation. It's about opportunity. Having liquidity when everyone else is forced to sell creates purchasing power that can generate returns for decades. The investors who accumulated cash during the euphoria of 2006 and 2007 were able to buy real estate, stocks, and businesses at prices that created multi-generational wealth. But cash alone isn't enough. You need to understand which assets will survive the storm and which will be revealed as worthless when the tide goes out. History shows that quality always wins in the end. Companies with strong balance sheets, consistent earnings, and essential products or services not only survive crashes, but often emerge stronger than before. Real estate follows a similar pattern, but location and quality matter more than ever during downturns. Prime properties in desirable areas may lose value temporarily, but they retain their fundamental utility and scarcity. Meanwhile, speculative developments in marginal locations often become completely worthless. The key is identifying assets that will be valuable regardless of economic conditions. This means focusing on necessities rather than luxuries, on companies that solve real problems rather than those riding temporary trends, on properties and locations that people will always want to live or work in. Precious metals have served as wealth preservation tools for thousands of years, but their role during crashes is often misunderstood. Gold and silver don't necessarily make you rich during economic turmoil. They preserve purchasing power when currencies lose credibility and financial systems break down. They're insurance policies against the complete collapse of paper-based wealth, not speculation vehicles for generating returns. The timing of your moves matters more than most people realize. Starting to prepare after the crash begins is like buying fire insurance while your house is burning. The opportunities are created during the build-up phase when debt levels are rising, asset prices are inflated, and optimism is widespread. That's when you accumulate cash, research quality investments, and position yourself for the inevitable reset. Dollar cost averaging becomes a powerful weapon during market crashes, but only if you understand how to use it properly. Instead of investing fixed amounts regardless of market conditions, you increase your purchases as prices fall and decrease them as prices rise. This approach allows you to accumulate more shares of quality assets when they are cheap and fewer shares when they are expensive. The psychological challenge is enormous because everything in your environment will be telling you to do the opposite. Financial media will be proclaiming new paradigms and permanent prosperity during the build-up phase. Your friends and colleagues will be making paper profits and questioning why you're being so conservative. Social pressure to participate in the speculation will be intense. Then when the crash arrives, the same media will be predicting permanent depression and the end of capitalism. Your social circle will be panicking and telling you it's too dangerous to invest. Every instinct will be screaming at you to preserve whatever cash you have left and wait for certainty before making any moves. This is exactly when fortunes are made, when fear is at its peak and everyone else has given up hope. That's when quality assets are available at prices that seem impossible. The investors who bought during the depths of 2008 and 2009 weren't lucky or particularly smart. They were disciplined enough to act when action felt most dangerous. Diversification takes on a different meaning during crash preparation. Instead of spreading risk across different asset classes, you're spreading opportunity across different types of value. Some positions will protect wealth during the decline. Others will generate massive returns during the recovery. The combination creates a portfolio that can profit regardless of what happens next. Debt becomes your enemy during financial crises because it forces you to sell assets at exactly the wrong time. Leveraged investors who seemed brilliant during the boom become casualties during the bust. They're forced to liquidate positions to meet margin calls or service payments, often at the worst possible prices. Staying debt-free gives you the flexibility to buy when others are forced to sell. The businesses that thrive during economic chaos share certain characteristics that you can identify before the crisis begins. They have strong cash positions, low debt levels, and provide essential goods or services that maintain demand regardless of economic conditions. They often emerge from downturns with increased market share and stronger competitive positions than they had before the crisis. Understanding government response patterns helps you position for both the crash and the recovery. Politicians and central bankers will always choose inflation over deflation because it benefits debtors at the expense of savers. This means that cash loses purchasing power over time, but assets that can't be printed or duplicated tend to appreciate. The key is holding enough cash for opportunities while protecting the majority of your wealth in real assets. International diversification becomes crucial when domestic markets face systemic risks. Economic crises rarely affect all countries simultaneously or with equal severity. Having exposure to markets, currencies, and assets outside your home country provides protection against localized collapse and access to opportunities that may not exist in your domestic market. The compound effect of crash investing is what separates the wealthy from everyone else. Buying quality assets at depression prices doesn't just preserve capital. It creates the foundation for exponential growth during the recovery phase. Assets purchased at 20 or 30 cents on the dollar can generate returns that dwarf anything possible during normal market conditions. Emotional discipline remains the most important factor in successful crash investing. The opportunities are obvious in hindsight, but terrifying in real time. Having a plan and sticking to it when everything seems to be falling apart requires a level of mental toughness that most people simply don't possess. Those who can maintain their composure and execute their strategy while others panic will capture the vast majority of the wealth that changes hands during financial crises. The infrastructure for the next great wealth transfer is already being built. Central banks around the world are quietly preparing for a monetary reset that will make the 2008 crisis look like a practice round. The Federal Reserve's balance sheet has expanded from less than $1 trillion before 2008 to over $8 trillion today. European central banks have pushed interest rates into negative territory, essentially paying borrowers to take money. Japanese monetary policy has become so aggressive that the central bank now owns more government bonds than the government itself issues each year. These aren't temporary emergency measures anymore. They've become permanent features of a system that can no longer function without constant artificial support. But artificial support always has limits, and we're rapidly approaching them. Government debt levels have reached points where even small increases in interest rates threaten to consume entire national budgets. Corporate zombies that should have failed years ago are being kept alive by cheap credit, preventing the creative destruction that normally cleans out weak businesses and makes room for innovation. Asset bubbles have inflated to sizes that make previous manias look conservative by comparison. The mathematics are simple and brutal. When debt grows faster than the economy's ability to service it, something has to give. Either the debt gets paid back with currency that's worth less each year, or the debt defaults and destroys the institutions that created it. Both outcomes transfer wealth, but in very different directions and through very different mechanisms. Currency debasement rewards those who own assets and punishes those who hold cash or fixed income investments. Real estate, stocks, commodities, and precious metals tend to maintain their value in inflation-adjusted terms, while bonds, savings accounts, and pensions lose purchasing power every day. This is the slow-motion wealth transfer that's been happening for decades, but it accelerates dramatically during crisis periods. Debt defaults work differently, but achieve the same result. When borrowers can't pay, lenders lose money and assets get liquidated at fire sale prices. The investors with cash can acquire these assets at fractions of their normal value, while the previous owners lose everything they thought they had built. This is the rapid wealth transfer that happens during acute crisis periods like 2008. The system we're living in now combines both mechanisms. Governments and central banks prevent defaults through money printing, which creates inflation that slowly erodes the value of fixed income assets. But eventually, the inflation becomes so severe that it threatens the currency's credibility, forcing a crisis that triggers massive defaults. We get the worst of both worlds: slow erosion followed by sudden collapse. Smart money understands this dynamic and positions accordingly. They borrow cheap money to buy real assets, knowing that inflation will reduce their debt burden while increasing their asset values. They avoid fixed income investments that will be destroyed by currency debasement. They build cash reserves during the inflation phase, so they can buy defaulted assets during the crisis phase. It's a strategy that profits from both sides of the wealth transfer cycle. The geographic dimension of this crisis adds another layer of opportunity for those who understand it. Economic disasters rarely hit all countries simultaneously or with equal force. The Asian financial crisis of 1997 devastated Thailand, Indonesia, and South Korea while creating opportunities in other markets. The European debt crisis that began in 2010 hammered Greece, Portugal, and Spain, while strengthening Germany and the Netherlands. The coming crisis will likely follow a similar pattern, with some regions suffering more than others. Currency relationships become crucial during these periods. Investors who hold assets in strong currencies while living in weak currency countries can maintain purchasing power even as local prices soar. Real estate purchased with dollars in countries where the local currency is collapsing can provide both shelter from inflation and massive returns when measured in the original currency. The key is identifying which currencies will strengthen and which will weaken before the crisis makes the relationships obvious. This requires understanding the fundamental drivers of currency strength: fiscal discipline, trade balances, political stability, and resource endowments. Commodity cycles overlay the financial cycles in ways that create additional opportunities. Basic materials like energy, metals, and agricultural products tend to spike in price during the early stages of monetary crisis as investors flee paper assets. But they often crash during the deflationary phase as economic activity slows and demand collapses. Understanding these patterns allows you to ride the waves in both directions. The technology sector presents unique challenges and opportunities during financial crises. Many tech companies have business models built on growth, funded by cheap capital rather than current profitability. These companies become extremely vulnerable when credit tightens and investor psychology shifts from growth to value. On the other hand, technology companies that solve real problems and generate actual profits often emerge from crises with stronger competitive positions as weaker competitors disappear. Artificial intelligence and automation may accelerate during economic downturns as businesses look for ways to cut costs and improve efficiency. This creates opportunities in companies that provide these technologies while threatening workers whose jobs become automated. The wealth transfer implications are enormous as capital owners benefit from increased productivity while wage earners face displacement and reduced bargaining power. Energy independence becomes a critical factor during global financial crises. Countries and individuals who can produce their own energy maintain more control over their economic destiny than those who depend on imports paid for with depreciating currencies. Solar panels, batteries, and other distributed energy technologies may provide both cost savings and strategic protection during periods of currency instability and supply chain disruption. Food security follows similar logic but operates on different timescales. During acute crises, having stored food provides immediate protection against supply disruptions and price spikes. During chronic inflation, owning productive farmland or food production capabilities provides ongoing protection against rising food costs. Both strategies transfer wealth from those who depend on just-in-time systems to those who maintain strategic reserves. The insurance industry faces existential challenges during major financial crises. Companies that promise to pay future claims with assets that may lose value face the same mathematical impossibility as pension funds and government programs. Policyholders who think they're protected may discover that their coverage evaporates exactly when they need it most. Self-insurance through asset ownership becomes more reliable than promises from institutions that may not survive the crisis. Healthcare costs tend to rise during financial crises, as stressed populations develop more health problems while having less money to pay for treatment. This creates opportunities in companies that provide cost-effective healthcare solutions while threatening individuals who depend on employer-provided insurance that may disappear along with their jobs. Maintaining physical health becomes both a personal priority and a financial strategy during economic turmoil. Education and skill development take on new importance when traditional career paths become unreliable. Workers who can adapt to changing economic conditions have more options than those whose skills become obsolete. But education debt becomes a massive liability during deflationary periods as graduates find themselves owing fixed amounts for degrees that may not provide the expected income. The key is developing valuable skills without taking on crushing debt loads. Social networks and community relationships become more valuable during crisis periods as formal institutions fail to provide expected support. Families, friends, and local communities that can share resources and provide mutual assistance have significant advantages over isolated individuals who depend entirely on market mechanisms. This represents a transfer of importance from impersonal institutions to personal relationships. Geographic mobility provides options that become crucial when local economic conditions deteriorate. Individuals who can relocate to areas with better opportunities have advantages over those who are trapped by mortgage debt, family obligations, or regulatory restrictions. This mobility premium increases during crisis periods as regional differences in economic performance become more pronounced. The legal and regulatory environment will shift dramatically during major financial crises. Governments desperate for revenue and control implement policies that seemed unthinkable during normal times. Capital controls, wealth taxes, and property confiscations become possible when populations are frightened enough to accept authoritarian measures in exchange for promises of security. Understanding these risks and taking precautions before they become obvious can preserve wealth that might otherwise be seized. Timing remains the most challenging aspect of positioning for financial crises. Moving too early means missing opportunities and earning suboptimal returns, while waiting for events that may take longer to unfold than expected. Moving too late means positioning after prices have already adjusted to reflect the new reality. The optimal approach involves gradual positioning that accelerates as warning signals intensify. The compound mathematics of crisis investing create outcomes that seem impossible during normal times. Assets purchased at 50% discounts that recover to normal values provide 100% returns. Assets purchased at 70% discounts that recover provide over 300% returns. These aren't theoretical calculations, but historical realities that repeat during every major financial crisis. But the real wealth multiplication comes from reinvesting those crisis gains during the recovery phase. Investors who doubled their money buying assets during the 2008-2009 crash and then used those gains to buy more assets during the following bull market achieved returns that transformed their entire financial lives. The combination of crisis buying and recovery compounding creates generational wealth for those disciplined enough to execute the strategy. History doesn't repeat exactly, but the patterns are impossible to ignore. The 2026 crash isn't coming to destroy your future, it's coming to create it. The question isn't whether you'll survive what's ahead. The question is whether you'll be prepared to seize the greatest wealth transfer opportunity of your lifetime. The next crisis is coming whether you're ready or not. But now you know how to position yourself not just to survive, but to thrive during the chaos that destroys the unprepared. The choice is yours. You can join the masses who will watch their wealth disappear, or you can be among the few who understand that every crisis creates unprecedented opportunities for those bold enough to act. If this opened your eyes to what's really happening, make sure you're prepared for what's coming next. The greatest wealth transfer in history is about to begin, and your position on the right side of that transfer could determine your financial future for generations to come. This is just one piece of the bigger picture. Subscribe if you want to understand the full context and how to better protect yourself in uncertain times. And the video on screen takes this story one step further.